Chapter 5 is all about earnings and profits and corporate distributions. Now, we talked a little bit about earnings and profits back in Tax 1 when we were talking about the taxability of dividends. We said dividends are taxable up to corporate earnings and profits, but we never really defined what we meant by corporate earnings and profits. At the individual level, they just get a 1099 DIV that tells them it's either a taxable dividend or a non-dividend distribution. But now we're the corporate accountants. We got to figure out which is a taxable dividend and which is a non-dividend distribution. And here's how we do it. First of all, there are three types of corporate distributions to stockholders. Cash, that's the most common type of dividend, a cash dividend. Property dividend is anything other than cash or also other than the third possibility, stock dividends, which is stock of the distributing corporation. So if the XYZ Corporation gives you shares of the ABC Corporation, that's a property dividend. But if the XYZ Corporation gives you shares of XYZ to add to your existing shares of XYZ, that's a stock dividend, and we will talk about stock dividends a little bit later. Cash dividends, the taxability, they are fully taxable up to earnings and profit. That we know from Tax 1. They are not taxable as dividend. They're called a non-dividend distribution if they are paid in excess of earnings and profits. But if you get a non-dividend distribution, you must reduce your basis in the stock. And if your basis in the stock is zero, you can't reduce it any further than that. And so now anything you get as a non-dividend distribution is going to be recorded as a capital gain. If you've held the stock more than a year, it'll be a long-term capital gain. What do we mean by earnings and profits? Well, first of all, earnings and profits are, you could say, analogous to retained earnings in that they are increased by items of income, and that'll be taxable as well as tax-exempt income. They are decreased by expenses, whether they are deductible or not. They're also decreased by dividends paid out. So that's very similar to retained earnings. But earnings and profits is not affected by a stock dividend, although financial accounting will frequently debit retained earnings in the case of a stock dividend. Earnings and profits are separated into current earnings and profits, which is this year's net earnings, similar to what financial accountants call net income. They are not the same as taxable income, but we will see that current earnings and profits start with taxable income and make adjustments to get current E&P. And then there's accumulated earnings and profits. That's really more like retained earnings. So it's the sum of all of the year's current earnings and profits minus amounts distributed, just like we do with retained earnings. To compute current earnings and profits, as I said, we'll start with taxable income, and then we will make adjustments. Here's a list of the most common types of adjustments. It is absolutely not an exhaustive list, but we will add back any dividends received deduction. So earnings and profits includes all dividends received. We're not going to subtract any of them out. Depreciation of personalty. Maker's accelerated depreciation is what we use for taxable income, but we're going to use straight line over the asset's class life rather than accelerated depreciation over the shorter maker's life. Depletion. Do not subtract depletion in excess of cost. I'm never sure why we're allowed to do that for taxable income, but we are. But we're not allowed to do it for earnings and profits. Inventory, LIFO is not allowed. It's very much a favorite for calculating taxable income, especially in an era of rising prices, but no LIFO for earnings and profits. The installment sale method, also very popular. You sold something and you're going to be getting installments before the thing is fully paid for. you don't have to recognize gain except in proportion to the installments you receive. So you get to defer recognition of gain until you receive the relevant payment. Not allowed for earnings and profits. If you have a gain, you recognize the whole gain in the year of sale. Long-term contracts, building ships and buildings and things like that. Completed contract is not allowed. You must use percentage completion. So there's a list of the sorts of adjustments we will make from taxable income to get to current earnings and profits. Again, not an exhaustive list, but these are the big ones. Let's do problem 27 from chapter 5. Sparrow Corporation, a calendar year accrual basis taxpayer, has the following transactions in 2024. It's a second year of operation. We have taxable income, $330,000, and then a lot of information that is relevant to that calculation of taxable income. They also tell us Sparrow uses LIFO inventory method, and LIFO recapture amount increased by $10,000 during 2024. So the LIFO recapture amount, that is the difference between LIFO cost of goods sold and what FIFO cost of goods sold would have been. FIFO cost of goods sold would have been $10,000 lower. In addition, Sparrow sold property on the installment method during 2023. So last year, they had an installment sale. They didn't have one this year, but they did have one last year. And last year, they sold the property for $40,000. Basis was $32,000, so an $8,000 gain, but they're going to be recognizing that for taxable income purposes on the installment method. We don't know how much they collected in 2023, but we do know that whatever it was, they're going to be paying tax at the rate of 20 cents on the dollar. $8,000 gain spread over $40,000 of collection. This year, they collected $15,000 on the installment sale, so we'll be recognizing for taxable income 20% of $15,000, but not for earnings and profits because we picked it all up in 2023. Finally, assume no additional first-year depreciation was claimed. So that's good. We don't have to worry about that. Again, for depreciation, we're supposed to be using straight line over the class life. First off, we had taxable income of $330,000. The federal income tax, $69,300, which is 21% of $330,000. They told us there was some tax-exempt interest income. Remember that any tax-exempt income is included in current earnings and profits. So add back the $5,000 of tax-exempt income that's not in taxable income, but is in E&P. The non-deductible portion of meals. They deducted half of the meals, as we usually do. Total meals, they said, was $3,000. And so the half that we couldn't deduct, we will subtract here. Non-deductible expense, but it is a subtraction for earnings and profits. Life insurance premium paid. The life insurance premium was $3,500, but there was also an increase in the cash surrender value. So that's effectively an increase in an asset, although it's not an asset recorded on the tax balance sheet. The net amount of the life insurance premium, that is the amount paid less that increase in cash surrender value, that is $2,800, and that is subtracted here, even though we couldn't deduct it for taxable income. Life insurance proceeds. We did collect on one of the policies $130,000. So we'll add that in. That's not taxable, but it is included in earnings and profits. But the cash surrender value on that life insurance policy, which we gave up when we received the payout on the policy, that cash surrender value was $20,000. So subtract that out. The net of $110,000 is our increase, not taxable, but definitely included in earnings and profits. There was an excess capital loss. They said the excess capital losses over capital gains, $13,000, couldn't deduct it, but we can subtract it here. So let's take a subtotal at this point. I'm only taking a subtotal because I'm running out of screen, and we are at this point $358,400. So we started at $330,000. We had some additions and some subtractions. That big life insurance proceed is the big addition there. And now we're at $358,400. So continuing on from there, maker's deduction in excess of straight line. They told us that the maker's deduction was $26,000. The straight line depreciation would have been $16,000. So we will add back the excess depreciation that we claimed for taxable income of $10,000. Section 179 deduction from 2023, that was $25,000. We're going to spread that over 5 years, and so they had to add back the $25,000 in 2023, and we can now subtract $5,000 a year. We did it in 2023, presumably, and now we're doing it again in 24, and we'll do it again in 25, 26, and 27. There was a dividends received deduction. We have a less than 20% interest in the stock that paid us the dividends, and the dividend we received was $35,000, so we had a dividend received deduction of half of that, $17,500. We have to add that back. LIFO recapture adjustment. They told us that the LIFO recapture amount is $10,000. So we took LIFO cost of goods sold $10,000 higher than it would have been under FIFO. So we will add back $10,000 there. That adjustment for the installment sale, we received $15,000 this year for the installment sale that took place last year. Well, the full $8,000 gain was included in earnings and profits in 2023, and so therefore in 2024, when we got that $15,000, we had to pick up $3,000 of gain for taxable income. We can subtract that out for earnings and profits. That gives us current earnings and profits of $387,900. So that's how you compute current earnings and profits. Start with taxable income and make all of the necessary adjustments. Dividends are paid first out of current earnings and profits. And that's done pro rata to all distributions during the year. So if you had any distributions, first look, did I or did I not have positive current earnings and profits? If the answer is yes, then first pull those distributions out of current earnings and profits and do it pro rata to all distributions that happened during the year. So suppose accumulated E&P at the beginning of the year is a negative $50,000. So we're not going to be distributing anything out of accumulated E&P. That's in a deficit. But current E&P for the year is $10,000. Now it might be tempting to say, well, we still have a $40,000 deficit. So therefore, none of my distributions are going to be taxable. It'll all be non-dividend distributions. That is not the case. You've got positive current earnings and profits, so distributions will come first out of current E&P. But suppose distributions during the year totaled $15,000. Well, then the taxable portion is $10,000, and the non-dividend distribution, what we used to call non-taxable dividends. But of course, we know that if you run out of basis, those non-taxable dividends are actually taxable as capital gains. So they changed the name about a decade or so ago, I forget exactly when, changed it to non-dividend distributions. And that's the term that the IRS uses now, so they don't have people yelling at them saying, this is a non-taxable dividend, why are you taxing it? Okay, fair enough. So the non-taxable portion, the non-dividend distribution, is the other $5,000. It can come out of current E&P because we use that up, and there is no accumulated E&P, so it's a non-dividend distribution of $5,000. Now I said this is going to be pro rata to all distributions during the year. So suppose there were two distributions. April, 9,000, October, 6,000. Okay, well that's our 15,000 that we distributed. 60% of the distribution happened in April and the other 40% happened in October. So the April distribution, taxable portion, 10,000 in total, split that up 60-40. 60% of the 10,000 is attributable to the April distribution and the other 40% to the October distribution. So the non-taxable portion is the rest of the distribution. 5,000 in total, that's 3 for the April distribution, 2 for the October distribution. So there's your 9 in April and your 6 in October. So that is how you treat distributions out of current earnings and profits. Dividends are paid next out of accumulated earnings and profits. In the previous example we just did, we didn't have any accumulated earnings and profits. But let's turn it around. Let's assume that we do have accumulated earnings and profits. Then, first of all, update your earnings and profits for any current earnings and profits deficit. Then, what's left is available to distribute to the shareholders as dividends. And we will apply that in chronological order to all distributions. Let's suppose our current E&P at the beginning of the year is $10,000. And then for the moment, let's forget about that updating for current E&P deficit. We'll get to that a little bit later. But just for simplicity right now, we'll assume current E&P for the year is exactly 0. We had break-even earnings and profits for the current year. So all we have is the $10,000 of accumulated E&P, and there was no current E&P deficit to worry about. So we will apply the earnings and profits of $10,000 in chronological order to the distributions during the year. Distributions during the year, 15,000. This is going to be exactly the same as our prior example. Taxable portion in total is 10,000. We know that that's all it can be. That's all the earnings and profits we have. The non-taxable portion, therefore, is the other 5,000, the non-dividend distribution. So our two distributions, April and October, 9 and 6. April, the taxable portion is 9,000. That's the total distribution. We've got 10 that we can distribute. There's 9 of it. The non-taxable portion is 0. The entire 9,000 on the April distribution is taxable. October, there's only 1,000 left, so that's taxable. And the rest of the October distribution is the non-taxable distribution. But you see the difference there. It's still 9 and 6. But when it was current earnings and profits, we applied the earnings and profits pro rata to the two distributions, 60-40. And when it's accumulated E&P, that comes out chronologically. So a lot more goes to the earlier dividends than the later dividends. Now, if it's the same shareholders in April and October, then nobody cares. But if it is different shareholders, if somebody sold or bought shares or something, that could be a big difference as to how those are taxed. If you have a brand new shareholder coming in July, they're not going to get taxed as much as somebody who was a shareholder back in April. Now, let's assume that current E&P was 40,000 and accumulated E&P was 30,000. So now we've got positive earnings and profits balances in both our current and accumulated. Of course, we can't go, it would be boring to do a $15,000 distribution. That'd be 100% taxable, and we don't really care whether it's coming out of current or accumulated. It would be coming out of current, but it wouldn't matter. But let's suppose there's 3 distributions, 20,000 in March, 50,000 in July, and 30,000 in September. So a total of 100,000. We've only got E&P of 70,000. So we know in total 70 is going to be a taxable dividend. The other 30 is going to be a non-taxable, non-dividend distribution. current E&P, we've got 40,000, which we will divide among the three distributions proportionally. 20% to March, 50% to July, and 30% to September. There's your 40. Accumulated E&P of 30,000, that's going chronologically. 12,000, that makes the March 1st dividend 100% taxable. There's only another 12,000 left of that March dividend because we already had 8,000 covered by current E&P. So the other 12 is a distribution of accumulated E&P. Now we've got 18,000 left of the accumulated E&P. That's all coming out in July because now we have a total of 38,000 of distribution from current and accumulated earnings and profits. And then there's nothing left of accumulated E&P to distribute in September. So there's our $30,000 of accumulated earnings and profits. So the distributions, the March distribution, 100% taxable. The July distribution, 38,000 taxable dividend and 12,000 non-dividend distribution. And the September distribution, 12,000 taxable dividend, 18,000 non-taxable distribution. There are four possible combinations of current and accumulated E&P when you have positive or deficit balances in them. So let's just summarize what we know so far. Current E&P, accumulated E&P, both positive. We just did that. Distribute current first, pro rata, then accumulated chronologically. That's what we just did. Current E&P and accumulated E&P are both deficits. We didn't do an example there because there's really not much to do. No distributions are taxable. Positive current E&P, deficit accumulated E&P, we saw that. That was our very first example where you distribute the current E&P pro rata to all distributions, and then everything after that is a non-dividend distribution. What's left is what we skipped over before, a deficit in current earnings and profits with a positive balance in accumulated earnings and profits. And this is the one where we update accumulated E&P as of the date of the distribution before computing the taxability of the distribution. So now let's do an example and show how that works. Let's assume we have a positive accumulated E&P of 15,000. We have a current earnings and profits deficit of 50,000, and that occurs evenly over the year. So the assumption is that we're just doing business during the year, and there aren't any big transactions. We'll see an example in a homework problem in a little bit where there is one very large transaction that happens on a specific day. There's a large loss attributable to that transaction. If that's the case, and the reason you have a deficit current E&P is because of that transaction, you pull that out and say that occurred on that date. But if this is just normal business, then you just divide it up evenly throughout the year. If it's a seasonal business, you might say, well, no, we're not going to divide it evenly over the year. We will make other adjustments. But generally speaking, certainly for our textbook, and I'm sure also for the CPA exam, it's either even throughout the year or there is a specific transaction where you'll be given the date. Okay, so that's what we're assuming. Current E&P deficit of 50,000 that happened evenly over the year. And there was a distribution of 7,000 on March 14th. So I say, well, all right, we've got accumulated E&P. Can we just assume all 7 is taxable? And the answer, of course, is no. That will not be the case. Accumulated E&P on January 1st is 15,000. Current deficit to March 14th, I chose March 14th very carefully. 73 365ths of 50,000 is exactly 20%. So there are 31 days in January, 28 days in February, and another 14 days in March. That's 73. So that's exactly 20% of 50,000, which is 10,000. And so therefore, accumulated E&P as of the date of the distribution is $5,000. So that distribution is taxable up to accumulated E&P at that date of $5,000. The other $2,000 is a non-dividend distribution. Let's do problem 31. At the beginning of the year, Teal Corporation had accumulated earnings and profits of $210,000. On March 30th, Teal sold an asset at a loss of $200,000. There's your single day transaction. For the calendar year, Teal incurred a deficit in current E&P of $305,000, which includes that $200,000 loss. If Teal made a distribution of $50,000 on April 1st, one day after that big loss, and the shareholder had a basis in her stock of $72,000, how will the shareholder be taxed? Here's a nice chart I like to set up with these four headings. The two on the left are all about the corporation. What is their current earnings and profits? What is their accumulated earnings and profits? The two on the right are all about the stockholder or stockholders. What is a taxable dividend? What is a non-taxable distribution? And non-dividend distribution, I probably shouldn't write there. Anyway, I'm an old guy. I'm still used to calling them non-taxable dividends. Even though it's been a decade or more since they changed the name, I'm still doing it. Okay, balance on January 1st is an accumulated E&P, $210,000. From January 1 to March 30th, current earnings and profits, this is just for what's happening evenly throughout the year. So it's out of the $105,000 deficit earnings and profits that is not accounted for by that $200,000 loss. And so we will update accumulated E&P for that amount as of March 30th. And we will also pick up that March 30th loss of $200,000. And you can see that we're now in deficit territory for accumulated E&P as of the distribution date. So that distribution on April 1, there's no earnings and profits left. And so none of that is coming out of accumulated E&P or current. It is entirely a non-dividend distribution. The rest of the year, that current earnings and profits, this is the rest of the $105,000. And so we'll bring that into accumulated earnings and profits as well. And so at the end of the year, our balance is negative $95,000 accumulated earnings and profits. One distribution, which is entirely a non-dividend distribution. Next, they do also want to know what is our shareholders' basis in the distribution. They told us that before this happened, it was $72,000. So she must reduce the basis by the non-dividend distribution, $50,000. So her basis after the distribution is $22,000. Let's do problem 35. Yi Ling, a sole shareholder of Brown Corporation, sold her Brown stock to Calvin on July 30th for $270,000. Yi Ling's basis in the stock was $200,000 at the beginning of the year. Brown had accumulated E&P of $120,000 on January 1 and a current E&P of $240,000. During the year, Brown made the following distributions: $450,000 cash to Yi Ling on July 1st, $150,000 cash to Calvin on December 30th. So we've got positive E&P, both current and accumulated. Here's our chart. Balance on January 1, accumulated E&P was $120,000. Current E&P, $240,000. Distribution on July 1, that was Yi Ling's distribution of $450,000. $180,000 out of current earnings and profits, and another $120,000 out of accumulated E&P. That's a total taxable dividend of $300,000, but you got $450,000, so the other 150 is a non-dividend distribution. We are now at 0 accumulated earnings and profits. The 1231 distribution to Calvin was 150,000. So that's the other 25% of the current earnings and profits. That's his 60,000, and nothing out of accumulated. There's nothing left. So he's got a taxable dividend of 60,000 and a non-dividend distribution of 90,000. So totals at the end of the year, current E&P is gone, so there's nothing to add to accumulated E&P, so we're now at 0. Taxable dividends of 360,000, 300 for Yiling, 60,000 for Calvin, and then non-taxable distributions of 150 and 90. So continuing on, Yiling's basis on January 1 was 200,000. Her non-dividend distribution of 150 reduced her basis on July 30th to 50,000. So her amount realized on the sale, Calvin gave her 270,000. Her basis is 50. She's got a long-term capital gain of 220,000. Calvin's basis on July 30th is what he paid for it, 270,000. He got a non-dividend distribution of 90,000, so his basis at the end of the year, $180,000. And that finishes our discussion of earnings and profits. We'll talk more about other types of distributions in the second video for Chapter 5.